In this video, we're diving into the mindset and methods of David Paul, one of the most consistent voices in trading. With decades of experience, he's developed a no-nonsense approach built on clarity, structure, and risk control. We've selected 7 of his most viewed clips on the ComLucro channel, covering trend filters, trade management, and real stories that shaped his edge. The video is split into 4 parts. Core ideas, a clear conclusion, one practical takeaway, and a simple plan you can start using tomorrow. Let's begin with a foundational idea, one that shaped David's view of charts and forecasting from the very beginning.
Mr. Gann said so beautifully, the most important part of a chart is the lowest tick of the highest bar and the highest tick of the lowest bar. I'll never forget that. Gann wrote an awful lot of stuff, and some of the stuff is really difficult. His early stuff, his mechanical method is relatively simple, but his forecasting stuff is difficult, and to forecast with it, you have to, in fact, be able to square the charts.
That's how you start to build a real edge, not with predictions, but with principles. Gann's method reminds us that the chart holds more than just price. It holds structure, context, and story. But spotting structure isn't just about theory. You need tools that actually help you read the market with clarity, session after session. And that's exactly where this next idea shines. David Paul doesn't rely on noise or guesswork. Instead, he uses a single technical filter, one that he's applied across asset classes for decades, to quickly define trend direction and filter out indecision.
How do you spot the trends in the Forex markets?
Well, simply, on a 4-hour chart, I use an 89 period moving average, and I've used that 89 period moving average in all markets for a very long time. On the stock market, on VectorVest, we have a proprietary tool which works out both the trend of the share and the trend of the general market. In fact, we work out a short-term trend and a long-term trend of both. In the Forex market, I think the basic definition put forward by Charles Dow in 1880 was a series of rising bottoms is an up market, a series of falling tops is a down market. The 89 period moving average works wonders, that's for sure. If the market's above an 89 period moving average, it's rising. If it's below, it's falling. But I like to see breakouts of patterns, reversal patterns. And a lot of that is quite intuitive. I remember that old fellow in South Africa that taught me this many years ago. He would put the chart on the wall and then he'd walk to the other side of the office and have a look at it. He says, yeah, it's going up. I think very importantly, any question that you ask yourself in trading should be binary, i.e. yes or no. Don't burden your mind with long essays. Is the market going up or down? Up. Is it sideways or trending? Every question that you ask yourself should be binary, a yes or no answer, okay?
Clarity is powerful, but sometimes the biggest trap in trading is not confusion, it's overconfidence in setups that look perfect on paper but fail in the real world. Textbook patterns like head and shoulders might seem reliable, but they often come with wide stops, unclear timing, and poor risk to reward. And David Paul doesn't just question them, he avoids them entirely. Here's why.
There's a head and shoulders reversal there, but I don't do that sort of stuff because the risk is a mile to make half a mile. Okay, it's great in the textbooks and whatever, but it's going to pull you in. It's then going to go back. If your stop's not the size of a number 27 bus away, you're going to get stopped out, and then it's got to go a hell of a long way for you to actually make any money. So a lot of that stuff works, in theory, but it doesn't actually make a lot of money.
Theory might look good on paper, but real trading is about risk, execution, and knowing when to step aside. And that's where rules come in. Not just general principles, but specific tested rules that keep your capital and your mindset protected. David Paul doesn't chase textbook setups. Instead, he works with rules that give him control over risk, profit, and timing. In this next clip, he shares exactly how he enters trades and, more importantly, how he exits with discipline.
We have some rules. One, start with a very small position with a stop loss well out of the traffic. Okay, and I base my stop losses on a technical thing called average true range, but that really doesn't matter. I don't like to give away any more than half my profit. For example, I was short the pound against the dollar 2 weeks ago. The same time as I got stopped out of the Dow trade, I was short the pound against the dollar from 26.10, flew down the page, I was up 300 points, and it then zoomed back up the page again. I got out at 150 because I have this rule of not giving away any more than half my profit. So I think that's something that's good.
Rules protect your downside, but sometimes the best trades come from moments you didn't even see coming. Not because you weren't paying attention, but because the market had its own plans. David Paul shares a story that every trader dreams of: a forgotten trade, a missed stop by a tick, and a runaway winner that unfolded while he was watching a concert. It's not about luck, it's about being in the game long enough for luck to find you.
The best one, without a doubt, is a copper trade that I did a lifetime ago. I put the trade on while I was in South Africa. And I didn't think I had any positions because I was sure that I'd been stopped out of this copper trade before I left South Africa. And I was going along to watch Celine Dion at the Royal Albert Hall. And in fact, what had happened was I'd missed the stop in copper by a tick or two. And the copper price had ran up the page, just ignored all those fib levels, it just kept on going. And when I opened up the brokerage account, there was thousands in it, completely unexpected. So I think that stands out as a wonderful trade. I just let it run. It ran up the page for weeks on end because I didn't think I had a position. Yeah.
Big wins get the spotlight, but it's the quiet routines behind the scenes that keep a trader consistent. It's not glamorous. It's just work. And the ones who treat it like a process, not a guessing game, tend to last longer. David Paul has built his workflow around that idea: consistent weekend analysis, automated alerts, and focused screen time during key sessions. Here's how he structures his week and why less time in front of the screen can often lead to better trades.
In the stock market, I do most of my work at the weekend, looking at fundamentals, looking at trends, and I have a system that monitors stop losses on that. I call it the Genius. And it sends me emails and messages if a share should get close to a stop loss. So I've got that pretty much mechanized where I look at it for 3 or 4 hours over the weekend. And probably don't need 3 or 4 hours over the weekend, but that's what I do. In the Forex market and the stock indices market, I trade Forex mostly on a 4-hour chart. And most of the moves will happen either in the London session about now or in the afternoon session when New gets going. So look at that 2 or 3 times a day.
Routines create structure, but analysis gives you timing, and that's where edge lives. Knowing when a trend is likely to turn can make the difference between riding a move or getting caught on the wrong side. David Paul approaches this with a balance of price action and momentum, using classic concepts like divergence to map potential turning points. In this final clip, he explains what technical analysis is really for and how to use it without overcomplicating your charts.
What's the goal of technical analysis? Well, I define it as the study of trends and turning points. So I'm looking for a trend, and then I want some knowledge of when that trend is going to stop. So I look at price, and I look at momentum of the price. And I use a concept called divergence, where if a market is falling and the momentum is rising, in other words, it's like you being in your car and you're slowing down. If you're in your car and you're slowing down, then there's a higher probability that you're going to stop and maybe turn than if you were speeding up. So if the price is falling and the momentum is increasing, then that means there's more downside to come. However, if the price is falling, but the momentum is slowing up, then there's a high probability of a turning point. And that's what's called normal divergence. Similarly, if the price is rising, but momentum is slowing up, then there's a chance that there's going to be a turn. In technical analysis, there's 1,000 indicators that measure the rate of change of price, momentum, they're all pretty much the same. There's things called rate of change, there's momentum itself, there's RSI, there's stochastics, there's MACD, there's a host of them.
In the end, that's what technical analysis is all about. Not predicting the future, but recognizing when momentum is fading, when a trend is aging, and when it's time to prepare for the next move. It's not about finding the perfect indicator. It's about developing the skill to read what the market is already trying to tell you. And once you can do that consistently, everything else becomes simpler. The setups, the risk, and the confidence to stay out when nothing's clear. So now that you've seen how David Paul approaches the market, with structure, clarity, and decades of experience, it's time to turn those ideas into action. Here's a simple, repeatable plan to apply before your next trading session. First, prepare with precision. Just like David, do your main analysis outside of market hours. Build your levels, map your trend direction, and know in advance where you'll act and where you won't. Second, simplify your decision-making. Ask binary questions. Is the market going up or down? Is it trending or sideways? Don't waste energy on guesswork. Reduce every choice to a clear yes or no. Third, define your risk and protect your profit. Start small. Use stop losses based on volatility, like the average true range. And when a trade moves in your favor, don't give back more than half. That rule alone can preserve both your capital and your confidence. Fourth, don't fall for textbook setups. If the risk to reward doesn't make sense in real conditions, skip it. It's not about being technically correct, it's about staying in the game. Fifth, automate what doesn't need your attention. Set alerts. Use tools that notify you when a stop is hit. Look at the charts only when it matters, like during the London or US sessions, and keep the rest of your time focused and free. And finally, stay ready for the unexpected. Sometimes the best trades will find you, but only if you're already positioned with a process you trust. Because real trading isn't about doing more, it's about doing less with more discipline. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.